Okay, good evening everybody. I hope you're having a good day. In this video, we're going to be talking about points of interest. Points of interest basically just mean areas where price buys and sells from. That's the simplest definition, and that's really all it should be. So, there are different types of points of interest. So we have the supply and demand areas, we have fair value gaps, we have key levels, and sometimes highs and lows, although that's not too often. I am only going to be talking about the points of interest that I use in my own trading, which are these four. Um, there might be more points of interest that other traders use, but I'm only going to be talking about these four today. Well, actually, I'm going to be splitting the video up into two parts. So this is going to be points of interest 1. The next one is going to be points of interest 2. In this video, I'm going to talk about the supply and demand areas and then the fair value gaps, because I don't want one video to be too long because it is going to be harder to watch for people who are trying to learn. So let's begin. We're starting with, of course, supply and demand areas. As the name suggests, of course, from economics, we know supply and demand, selling and buying, buying and selling, all that stuff. So basically, when I say supply and demand areas, I'm referring to order blocks. Order blocks simply means just, okay, there are areas where a lot of orders are packed up and piled up, so price normally retraces into those areas to pick up the orders before continuing in the direction it wants to go to. So that's the logic behind it, but let me show you what it looks like on the actual charts. So let me start with the illustration. Of course, let me explain the illustration, and then I'll come to this chart on gold and I'll show you an example of an order block and how it works and whatnot. But of course, we'll begin with the illustration. Okay, so like I was saying, let us begin with the illustrations. Let us begin. So, as we can see here, if we go back to my video on basic market structure, we can see this is a bullish structure, a buying structure. Why? Because we are making higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows and whatnot. We are getting breaks of structure to the upside. So price keeps pushing upwards and upwards and upwards. So we're getting higher highs and higher lows, right? So that's bullish structure. Now, an order block, what it looks like this. We can see this downward move, right? And basically this last candle before the opposing move that breaks structure, that's what our order block is. That might sound like a mouthful, but it's not. Basically, let's look at this, for example, this break of structure, right? We got a break of structure. So next we will expect price to retrace, of course, into the area before it continues buying, right? But now what do we expect price to retrace into? That's the question, right? Okay, so if you look at it as per candles, right, you'll see something like this, a downward move and then the opposing move like this. So that's very last candle before the opposing move that causes a break of structure. That is what we call an order block. I do hope it doesn't sound complicated, because it's actually quite simple. Just imagine, um something like this, right, and then you get a break of structure, right, something like this and a break of structure, right? So basically now this would be, let me bring this down, so it would be like this. As we can see, this downward move, you can look at these candles here as this downward move, right? And then the very last candle before the opposing move that breaks structure is this one right here, and then this is the opposing move that breaks structure, right? So this is what it looks like this last candle before the opposing move that breaks structure. So as we can see, same thing here, break of structure, right, come back, break of structure, right? So if you come here, you see something like this. You see downward candles, and then the very last downward candle before the move that breaks structure. You see, very last candle before the move that breaks structure to the upside. That is your order block. Basically, that area now has a lot of resting orders that the market wants to pick up, because it's money, of course, so the market is going to come back for it. So it's the area that fueled the break of structure. It sponsored the move that broke structure. So now we expect price to come back into that area and retest it, to revisit it before it continues in its intended direction. Basically, that is what it means. Move down, move up. So now as you look at that move down, the last candle before the opposing move. So this is, let me flip it around so that you can see it for sells as well. So now this is a bearish movement, right? Bearish movement, right? As we are getting lower highs and lower lows, lower highs, lower lows, lower highs, lower lows. We're getting break of structure, break of structure, break of structure, downside, down, down, down. Price is going down. Very clear bearish movements, right? So now we got a break of structure here, right? Price retraced. We got a break of structure. So now we look at this break of structure right here. What sponsored that break of structure? What pushed price to break structure, right? And then you zoom in on it, and you'll see something like this. We can see this retracement leg here. That's these candles, these upward candles. And then you look at that very last upward candle before the opposing move to break structure. That is your order block. That is the area that sponsored the move to break structure. Basically, in the simplest way, it is just the area that sponsored the move that broke structure. Yes, that's the simplest way to put it. So as we can see, this right here, it broke structure. So we expect price to revisit that area, to pick up all those resting orders, to pick up all that money, so that the market has fuel to keep moving, right? So it retraces to that area, picks up the orders, and continues in its intended direction. And as for how it looks, you'll see it's like this: upward candles, right? And that very last upward candle before the opposing move that breaks structure, that is your order block. We can see it right here, right? That is for continuations, of course. Let me give an example now of, okay, let's say now, instead of continuing to break structure, let's say as price is pushing down now, pushing down. So now as it comes here, instead of coming here and then giving us a break of structure, it gives a market structure shift. That is a reversal, a movement from selling to buying. That's market structure shift. We talked about that in the basic market structure video. Price is selling, breaking structure, and then what happens? It reverses into buys. That's a market structure shift. The power has moved to the buyer's hands. So now we come here and look at it like this, right? We come and look at it like this now. What sponsored this market structure shift, right? What exactly sponsored this market structure shift? And then as you zoom in, you definitely see a 3 candle formation. Not this one, this is for sells. So you will see a 3 candle formation. You'll see a downward candle. No, not necessarily 3 candle. Let me not say it has to be 3 candle. It doesn't need to be at all. You see a candle formation. As you can see, downward movements, right? And then this very last candle before the opposing move that breaks structure, that is your order block. Because we can see it, that is the area that sponsored the market structure shift, right? This right here, the area that sponsored the market structure shift. So we expect price to revisit that area to get fuel to continue in its intended direction. Like this, right? Right, exactly. So let's flip it back and explain for the other as well. So now price is buying. You can see price break of structure to the upside, buys, and then right here, instead of coming here and giving another break of structure, instead of continuing, it comes and gives a market structure shift. So price has moved from the hands of the buyers to the sellers. The power has moved to the hands of the sellers. So then of course we come and look at this and say what sponsored this move that gave a market structure shift, and we look at it and then we'll see a candle formation. Of course there's this upward move right here, we'll see upward candles, right? And then right here, that last candle before the opposing move that breaks structure, right? That is your order block. That is the area that sponsored the market structure shift. That is the area that sponsored this move down. So what do we expect? We expect price to revisit that area, to retest it, and then continue in its intended direction. So now let's move to the chart and show chart examples of an order block. So this is the 4-hour chart on gold, right? So as we can see, gold has been bullish, gold has been buying, it's making new all-time highs, right? It is currently, it made a new all-time high today actually, but that's not the point of this video. So right here, right, we look at this. Let me say something. Price will never, in real life, price will never look as smooth as the illustrations I show, because there's many things that influence price, so it will never look smooth, like just very clean. But when you get used to analyzing, your eyes get used to seeing what is going on and understanding it. So for me now, I can look at this chart and I fully understand what's going on. But for someone who is kind of newer to it, it might be harder for them to understand, okay, this is what price is doing, this is what price is doing, right? It will be harder for them to understand. But with time, not even too much time, with just a little time, and just getting used to watching the charts and analyzing, your eyes will pick up things very quickly and you'll understand them. So now, not the point of this video. So now, what we can see right here, right, this is a high, right? And of course it's a high. Like I said, it will never really look as it will never look like my illustrations exactly, but your eyes will still see what's going on. So right here we have a high, right? And then what happens? A break of structure, right? That's a break of structure. And then what again is this is also another high. So once price goes above it, what do we have? We have a break of structure, right? Right, exactly. So now when you zoom in to this, when you zoom into this area, what do you see? I can clearly see that price, it made this high, it retraced into this area, and then it broke structure. So now we look at what sponsored the move that broke structure, right? That's what we look at next. So now the thing that sponsored the move that broke structure, as we can see, it's not this one, because price came up, came down. It's not this one, price came up, came down as well. But then you see from here, right here, this very last candle before the opposing move that broke structure, that is our order block, right? That is our order block. This very last candle, right? You can see price came like this, broke structure, right? So what sponsored that move? It was this very candle, this last candle right here. You can see it pushed price up, sponsored the move that broke structure. So now what we expect, of course, like I said, it will not always happen, but what we expect is for price to revisit that area, retest it, right? And continue in its intended direction. As we can see, price gave a very good move from there, but I'm not saying this is an entry model. I'm not teaching entry models in this video. That is something we'll talk about later down the line, because it's more advanced. So you don't just find any order block and place your buy or sell there. More goes into it, but this is about understanding order blocks. So we expect price to visit that area, retest it, and then continue in its intended direction. And this is a perfect example of an order block. Right here, it sponsored the move that broke structure. It sponsored the move that pushed price like this. And then price retraced into it and then gave a very good move, continuing in the direction. So now, let's look at it for sales. Right? So now, if we're like, this is inverted, so now it's selling, right? We can see right here a low, a lower high, like this is a lower low, and then a lower high here, and then we get a break of structure, right? And then right here you can see it's a low, right? Price retraces into this area and makes a lower high, and then what do we get? Right here we get a break of structure, and then what do? We zoom in, we look at it right here, we say what sponsored this move to the downside. It's definitely not this one. You can see price came down but then came back up, it did not break structure. Same thing here, came down, came back up, it did not break structure. But this very last candle here, it sponsored the move that broke structure, broke below this. It sponsored that move. So what next? We expect price to revisit that area, to retest it, and then from there sell off. And that's exactly what happened. Like I said, this is not an entry model. This is about explaining how order blocks work. And that's exactly what happened here. Price revisited this area, tapped it, and gave a very good move off it. So basically that is what an order block is. It may not always look like this, it can look different ways, like for example, like I said, we don't always expect price to retrace to order blocks, because if you look at this area now, this is also an order block right here. Because what happened, you can see after price moved its move like this, it retraced here, right? It gave a lower high, and then what? It broke structure right here. Let me mark it out. Price broke structure, right? It broke structure. So normally we would expect price to retrace to this order block and pick up the orders before continuing in its intended direction, but that does not always happen. That does not always happen. So but then that's why we use a bunch of different points of interest, because price will not always just go back to your order block or to your fair value gap or to your key level. So you need to have an understanding firstly of the points of interest, but then you need to also understand the currency pair or commodity that you are trading. You need to understand what points of interest it prioritizes more, but also that's more advanced stuff. That's not for this video. Here we're just trying to understand the different points of interest. So this right here, this is also an order block that was not retraced into, it was not retested. So but it is definitely a valid order block, as we can see, last opposing candle that sponsored this move. This could also be an order block, but then it's more, it's lower probability, but you could also mark it out because it's an opposing candle, sorry, it's a candle before the opposing move that broke structure. So that could also be an order block, so but basically this right here, you can say mostly sponsored the move, but you can also call this an order block. And if you look closely, you can see, sorry, if we look closely, we can see right here, price tapped this order block, right? Tap this one and it kept moving. So that's most likely the reason why it did not even retrace all the way to this extreme order block, because it tapped this one. But even if it didn't tap this one, it's normal, because sometimes price does not retrace to your order block. So let me invert it so that you can see both ways as well. You can see order block here sponsored this move, right? And then we got a retracement in a higher low, because we are buying now, a higher low, and then what? A break of structure. So this mostly sponsored the move, but then as you can see, before you got the break of structure, there was this candle here. That was the last candle before the opposing move that broke structure. So as you can see, price tapped it and continued upwards. So basically that's it for order blocks. You can start using order blocks with just this knowledge and get a deeper understanding of it. Even in the future, I'll make videos, single videos on these points of interest to delve deeper and help you guys get a deeper understanding of them individually. But so that this video won't be too long, that's it for order blocks. So now let me delete this. Now we are going to talk about fair value gaps. That's next. Those are like I said, those are the two things that we will talk about in this video: order blocks, fair value gaps. Right. So yes, let me finish deleting this, and then we can start with the value gaps. Yes. Okay. I know it's taken so long. Okay. So now, firstly, before I draw anything out, a fair value gap refers to an imbalance in the market, an inefficiency, that needs to be rebalanced, an imbalance that needs to be rebalanced in the market. So basically, now let me illustrate it out for you. It is a 3-candle formation. It's not like, oh, most times it is or sometimes it is. No, it is always a 3-candle formation. Always. So we can see now 3 candles right here, right? So now what is a fair value gap exactly? So now let me finish marking it out so that I can show you guys. So we see the first candle, second candle, right? And then the third candle, right? So now what is special about this? You might look at this and think, oh, this is just like any other 3-candle formation, but no. As you can see, this is in the case of a bullish fair value gap, a buying fair value gap. The top wick, this top wick of the first candle and the bottom wick of the third candle. We haven't really talked about candles, but maybe later I will make a video about it. But this thing here is called a wick. This line that comes out of top and bottom of candles, it is called a wick. And all candles have it. And this is the body of the candle itself. So when we are buying, this is the open and this is the close. Same as this, if they're all bullish candles, buying candles. So now, a fair value gap, as the name even implies, it is, you see, when there's a gap between the top wick of the first candle and the bottom wick of the third candle in the 3-candle formation. Basically what this is, it is an imbalance. The market doesn't like to leave imbalances behind. So when you get something like this, it is an imbalance, it is an inefficiency, and the market needs to rebalance it so that it can continue its upward movement in peace in the case of a bullish fair value gap, right? Because let me show you what isn't a fair value gap, like a 3-candle formation that isn't a fair value gap, right? So you can see first candle, right? Second candle, right? Third candle, right? I'll explain why I'm illustrating the third candle like this in a minute. So you can see first candle, right? That's the wick. The wick can look a bunch of different ways. It can be long, it can be short, so you can see this right here, right? The wick for the middle candle really does not matter. It's unimportant. It just depends on the wick of the first and third candles. So just don't bother about that. So then you see the third candle right here. So now, what makes this different from this? As we can see here, the top wick, of the first candle, right? As we can see, it intertwines with the bottom wick of the third candle. There is no gap in between them. There's no inefficiency that market needs to come back to. There's no imbalance that market needs to rebalance, because what the top wick of the first candle and the bottom wick of the third candle, they come across each other, they touch each other, they tap each other, whatever word you want to use for it, they intertwine with each other, right? So that is what makes this 3-candle formation different from this 3-candle formation. The fact that there is this gap between the top wick, of the first candle and the bottom wick of the third candle in the 3-candle formation. It is always a 3-candle formation. So as we can see, in this case, they intertwine with each other, so there is no gap. There's nothing that price needs to revisit here. But in this case, there's this gap that price revisits in most cases. In most scenarios, price will come back to that gap, but there are situations in which price does not come back. Sometimes it has a reason, sometimes the market just does what the market does, basically. I don't know what's going on with the Wi-Fi. 1 second. Okay, yeah, it's back. Okay, so now let me show it in a bearish scenario, selling scenario, right? So now we can see the difference between these two. So here we have the first candle in the formation, right? And then the second candle, and then the third candle, right? So as we can see in this selling scenario, the bottom wick of the first candle and the top wick of the third candle, they do not cross each other, they do not intertwine. There is a gap between them. Like I said, the wick of the second candle, the middle candle, doesn't really matter. You can look any way it wants to, but the candle itself needs to be this expansion type of candle. It needs to move enough to leave a space in between this wick and this wick, basically. But how the wick itself of the middle candle looks, it doesn't really matter. It doesn't really matter. So you can see the bottom wick of this very first candle and the top wick of this third candle, they do not intertwine here. So there is a gap, there is an imbalance that market needs to rebalance. There is an inefficiency in the market, and the market doesn't like leaving behind inefficiencies. But we can see for this one, there is no such thing. So the market can continue without coming back into this area. It doesn't need to, there's nothing drawing it back. So that is really what a fair value gap is. And usually this is really something I should talk about in the fair value gap video itself when I'm explaining it on its own. But usually when like the third candle in the formation is also an expansion candle, a big candle like this, in most cases it will not come back to this candle, it will not come back to the gap, because then it turns into a breakaway gap. Just, you know, a breakaway gap is a gap that's not expected to be retraced into, and even if it is retraced into, in most cases it will be later, not instantly. Like let's say it looks like this, the body of the candle is very small. In most cases we can expect market to come right back into it instantly before continuing up. But in a scenario where the third candle is big like this, most cases it will leave without coming back, but sometimes it can come back. But that one too, in most cases it must like move upwards before coming down. And it's the same for selling as well, you know, it's the same for selling. So that's why I'm drawing the bodies of the third candle so small like this, so we can see this very clear gap. So let me come to, you see an example right here. First thing I see, an example right there. What do we have here? This is a fair value gap. I'll zoom in and show it more clearly. So as we can see right here, right? What do we have? Sorry. As we can see, there's this first candle here, right? Like I said, it doesn't really matter what the body of the first candle looks like. It does not matter. So you can see normal looking candle here, right? And then we can see this one has a long wick, doesn't really matter. This is the middle candle, right? It doesn't matter what the wick looks like. What's going on with the Wi-Fi? Yes, so as I was saying, we can very clearly see first candle looks very normal. Second candle, it has a long wick, but it doesn't matter what the wick looks like. We can see the body is an expansion candle. It moves, and it moves enough to leave a gap between the top wick of the first candle and the bottom wick of the third candle. So you see that right there, it is an imbalance, it is an inefficiency, it is a gap, and market needs to come back and fill it up. So like what I was talking about just before I came to the chart, as we can see, this third candle also kind of moves up. So you know, as we can see, price did not retrace into it right then and there. It moved up, but then it eventually came back, but that doesn't really matter for now. We can just see fair value gap, this gap between the top wick here and the bottom wick here. So let me invert it so that we can look at it for sales in a bearish situation. you can very clearly see right here. First candle, normal looking. Second candle, long wick, doesn't matter. Third candle here, so we can see a gap between, in a bearish scenario, between the bottom wick of the first candle and the top wick of the third candle. So the wick is this thing that comes out of the candles. We can see there is a gap between them. They do not touch each other. So this is an imbalance, and the market needs to rebalance it. If not, the price action is inefficient. It doesn't always rebalance it, but in most cases it does. And there are scenarios where, you know, it doesn't even, price does not continue from there. So like I said, you need to understand the currency pair or the commodity that you're trading and what it prioritizes, and, you know, look at the sessions and look at what points of interest it respects more during those sessions and whatnot. But those are more complicated things that we will talk about in later videos. Let me find an example of a fair value gap that did not work. Also, let me say something. A fair value gap isn't really invalidated. Like, let's say, for example, now, price does something like this, right? Let's say here, instead of coming like this and moving up, let's say it came like this, overextended it a bit, but it does not close below it and comes back up right here. It's still a valid fair value gap. Like, it has been respected, because as long as price does not close below it with a body. Because look at this wick right here. Let's say this wick extended all the way here, but it still came and closed above the fair value gap like this. The fair value gap has been respected. It has not been invalidated. But for an order block now, let's say this came and it wicked below it. It just went below it. Even if it doesn't close below it, if it went below it like this and still came up, the order block has been invalidated. But you can see this one got respected. You can see it got respected. So yeah, let me find an example of a fair value gap that did not work. So let's see. Okay, let's look at this one here. So you can see right here, look. So you can see, like I said, it doesn't matter what the first candle looks like, although it's higher probability if the first candle is also bullish, you know, like the other two, or in a bearish scenario if it's bearish. But you see, in this case, it would have been higher probability if the first candle was bullish. But most cases, it doesn't really matter what the first candle looks like. So we can see first candle, and then second candle, expansion. That's good. It moves up enough to leave a gap between this first candle's top wick and this last candle. The last candle doesn't even have a bottom wick, so, you know, but still it is a fair value gap. You just need space between here, and that's your gap, that's your imbalance. So you see, in this case, market retraced right into it, because this candle did not really move that far. Market retraced right into it, and you see, even at this point, price has not closed below it. So even at this point, it is still being respected. Even at this point, right? At the point where it gets disrespected is when this candle gives this close below the fair value gap. That's when you know the fair value gap has been invalidated. It has not been respected, right? So it failed as a fair value gap. Let me invert it so that you see it both ways. You can see price is bearish, of course, you know. So like this, leave this gap here. Like I said, it's being respected up until this point. That's when price closes outside it. So we know it has been invalidated. You understand? So that is really all there is to say, like the basics for fair value gaps and order blocks. I think with this knowledge, you would have enough to be able to use these 2 points of interest and learn more about them and study them. And after, you know, I make the second point of interest video talking about key levels and highs and lows, although highs and lows there isn't really much to talk about, it's just a little bit, so that video will probably be shorter than this one. But Yeah, maybe after I make that video later down the line, I can make videos individually on each of these points of interest, going in depth about them, about their intricacies and their deep workings, and what is valid and what is invalid, and sessions where they mostly work and the pairs they mostly work on. Like, but these will only be looking at the pairs I personally traded. Like, let me show you my watch list. As you can see, I trade XAU USD, that is gold. I trade GBP USD, that's the British pound against the US dollar. I trade USD JPY, that's the US dollar against the Japanese yen. And then I trade NAS 100, also known as US 100 cash CFD. So this is, how do I explain it? The gold, anyways, is a commodity. These two are pairs, forex pairs, and I'm not sure it's called this. I don't think it's a commodity. I can't remember the name. But yes, this is what there is to say about order blocks and fair value gaps, and I will see you in the next video. Thank you very much for watching.